described earlier, depreciation is the systematic write-off of the cost of tangible capital assets over the useful lives of the assets in order to fairly match the cost of the assets to the revenue earned by them, while amortization is used to write off a portion of the cost of intangible assets. There are several methods used by businesses to account for the depreciation of capital assets. Regardless of the method used, everyone accounts for this write-off by using an account called accumulated depreciation. This account is used to accumulate the amount of depreciation that is written off for each group of assets. Assets are grouped into classes in the books of the company, and in some larger companies, the details of all the assets purchased and sold are recorded in a subsidiary ledger account. Each group of assets has a contra account set up called accumulated depreciation with the name of the particular asset to which it relates following the words accumulated depreciation. For example, the accumulated depreciation account that relates to buildings would be called accumulated depreciation buildings. There are two common methods of claiming depreciation on the books of a company. A company may choose whichever method it wants, provided it consistently uses the same method year after year. The company would choose the method based on whichever method more fairly matched the depreciation expense with the revenue earned in the period. The two methods we will consider are called the straight line depreciation method and the declining balance depreciation method. Straight line depreciation is a method of writing off the original cost of capital assets by assigning an equal charge to revenue over the estimated useful life of the asset. The charge to revenue is calculated based on the original cost of the asset. The formula to calculate the amount of straight-line depreciation each year is cost of the capital asset minus residual value divided by the expected useful life of the capital asset, where the residual value is the expected value of the asset at the end of its useful life to the company. For example, a company purchases a piece of equipment that has cost $20,000 and is expected to have a useful life of 5 years. It's estimated that there will be no residual value at the end of the 5 years, which means the equipment will be scrapped at that time or sold only for a nominal amount. The asset was purchased April 1st, and the company has a December 31st year end. Using the formula for straight-line depreciation, you can calculate the depreciation for a full year. The cost of the asset is $20,000, and there is no residual value. So $20,000 minus 0 is divided by 5 years. The amount of depreciation equals $4,000 per year. Since the equipment was purchased in April, the number of months remaining in the year to the fiscal year end would be from April to December inclusive, or 9 months. The depreciation for the first year would, therefore, be $4,000 times 9 months divided by 12 months, which equals $3,000. In the task, you will practice calculating depreciation using the straight line method.